fact, let's take this conversation forward. This is exactly what we're going to be discussing with Ravi Menon, IT services analyst at Macquarie Capital. So much going on with the Indian IT services landscape. There is, of course, this H-1B visa, the 1 lakh USD fee that's been levied. And Accenture sounded a little, shall I say, well, muted with respect to their guidance last week as well. Ravi, great to have you in. Before we talk about any of this, actually, I want to start with the Hire Act because that's the next thing. Now, I don't know, are you assigning any probability of that becoming a reality, that companies that offshore work, they will be taxed at 25%? I don't know if you've even started modeling the impact of this, because this could be far more significant than H-1B, won't it?
See, this affects every single corporate in the US, right? And there is no distinction between whether they do it out of their GCC or whether they do it through a service provider. So I would think that affects entire corporate America, right? And you have even small supermarket chains who actually send work, and even they have GCCs now in India. So I think it's, since it treats all firms equally, I don't think this is something that we should really worry about. Seems unlikely. I mean, on one hand, you have tax cuts, and on the other hand, have a tax increase like this. I don't think that actually makes sense. So I wouldn't really worry about this, and there is no point in, I think, assigning a number to it, because there is not going to be a revenue impact or a margin impact from that, because it affects clients even if they do it themselves. The only question is there an alternative to doing work out of India? And so I think it's pretty much no. In fact, people who try to do it out of Eastern Europe, you're now seeing those or Latin America. Those companies now, you have them scaling up here, and India is their fastest growing delivery location.
Ravi, hi, morning. Let's drill it down to your coverage universe, Ravi. Where are pockets of value now? Or is it still very, very hazy and unclear ahead?
No, I think that definitely we are very much in value territory. I think that we've had a growth slowdown that I don't think anyone expected to last as long as it did. We still have probably a couple of quarters to go before things start picking up, but I'm more hopeful about next year's budget cycle. There will still be some verticals where I think the heightened uncertainty of tariffs makes it difficult for them to embark on significant spending, like manufacturing, retail, even healthcare to some extent, because there is a lot of regulatory uncertainty. But BFSI, high tech, these are picking up. So I think next year definitely looks like a better year. And evaluations are, I think, a lot of good value we had. I mean, last time we had HCL Tech, for example, trading at 5% free cash flow. In the next 12, 18 months, we saw the stock deliver more than 100%. We are at more than 5% right now. So I think that's very attractive. TCS again, now more than 4.5% dividend yield, very attractive in my mind. We're expecting significant margin expansion and an acceleration revenue growth for TCS to drive a re-rating over the next 12 months. That's our topic for now, TCS. That's a Macquarie marquee buy. And among the mid caps, we like Persistent Systems and LTTS.
Right. Hi, Ravi. Good to see you in. And in fact, you're sounding a little bit optimistic, actually, on the space turning around. That cash flow yield is something that actually is supporting it. But I don't know, on a weekly basis, some sort of negative news comes in. My colleague Rima joins in and tells us about that. But you're sounding a little bit optimistic. That said, I think TCS is one of the top buys, right, as you briefly said. But they're not able to get to that band, that margin band. I think 26, 28% is what they're talking about. When do you think they get to that mark? And also, AI in the near term could be a bit of a challenge. There'll be a lot of investment going in there. It could be deflationary in nature as well. So comment on that. TCS getting to that band and the impact of AI on a company like TCS.
So first of all, I would say that AI, I'm an AI optimist, I would say. I think of that as definitely revenue accretive. I think that it'll be margin neutral. There are companies like LTTS, for example, which actually believes that it'll be margin accretive as well, because they think they have a lot of AI-based platforms. They're going to change how they bill for revenue. I think that it unlocks actually a whole new opportunity of legacy rewrite. I mean, earlier it was very expensive and risky to undertake that. Now, and very difficult to make a business case, right? You're going to replace a system, an old system, with a new system written in new technology, but works exactly just like the old one. Very difficult to actually fund that, especially when it involves multiple years of effort and a lot of money. Now that rewrite effort's gone down, the risk of the rewrite's also gone down. TCS last year showcased a framework that I call future-proof legacy modernization. I think that was pretty powerful. They showed a lot of investments actually in AI last year, and that's when I upgraded that to be my topic. We've seen them declare a rewrite project of mainframe with one of the North American banks a couple of months back. So you see that press release. So I think that that's a big opportunity that we're just starting to see the early signs of.
Yeah. Ravi, just very quickly, since you mentioned that you are expecting some pickup in spends, by when will it show up? And say for your big large cap pick TCS, just trying to understand what is the kind of volume growth, or say top line growth, that you would work with over FY27 perhaps?
So FY27, I think we would still be only like a 6 to 8% sort of range. It won't be going to a double digit. I think at the size of TCS anyway, it's actually very difficult to get a double digit unless the market's, firing on all cylinders, right? I mean, demand on for all the sectors improves. And I think by FY27, we will still not see that. Perhaps FY28, we could see that. Going back to Nigel's question of 26% margin, I think towards the end of FY27, we're likely to see that them return to 26% margin. Because I think the restructuring they're undertaking now, that will fund the wage hike for this year. But beyond that, I think margin improvement still seems difficult without revenue growth. So next year, when we have the revenue growth of at least 6%, 7%, I think that's when we can see margins expand.
Okay. All right. Good conversation, Ravi. Thank you very much. Helpful perspective there. You have a good day. Well, that's a view from a Macquarie coming in on IT services. Not all gloom and doom. They're expecting some turnaround in the coming quarters.